Silver's going to suddenly outperform gold. Why are the silver miners going to stay below the gold miners? They should do effectively the same thing. And technically, they look poised to do just that. And by the way, on a net price basis, the current surge that we're in the miners in general, like GDX, GDXJ, or SIL, I think it's easy in the next 3 to 5 months that we will exceed the 2011 price peaks. I think that's no issue. And of course, if gold ever does its normal, which is to say an eightfold move, and XAU goes up to 17.5% or triples its current relative value, wow. I mean, it will be the hottest place in the market. And the issue is you should have gotten in already. And if you're going to get in, you better get in now, because in 5 months from now, it's going to be a much higher risk, much more volatility, and you're getting in late.
Silver prices have firmly established themselves above the critical $35 per ounce mark over the past 2 weeks, a development that has reinforced bullish sentiment among analysts. While gold has benefited more immediately from safe haven demand, concerns over industrial demand and global manufacturing softness have somewhat restrained silver's gains. Nonetheless, the sustained breakout above $35 suggests growing investor confidence in silver's dual role as both an industrial metal and a monetary asset. MichaelOliver of Momentum Structural Analysis emphasizes that silver is beginning to reassert its monetary status, moving beyond its traditional image as merely an industrial commodity. He also points to the gold mining sector, which appears to be emerging from a decade-long period of consolidation. Historically, miners tend to outperform the underlying metal during bullish cycles, making them an area of interest for investors anticipating continued strength in precious metals. Gold, meanwhile, is posting solid gains, up around 1.5% during Asian trading on Friday. This upward move is driven by a renewed flight to safety amid intensifying geopolitical tensions between Israel and Iran, and reinforced by expectations of Federal Reserve rate cuts. XAU-USD climbed to over $3,425 in the Asian session, marking a 5-month high. With gold rallying for the second consecutive day, the focus is now on whether it can maintain momentum above the $3,400 level. Minor resistance lies at $3,417 and $3,431. A decisive break above these levels could pave the way for a move toward new all-time highs. MichaelOliver notes that if gold were to repeat its previous 8-fold move from the 2015 bear market low of approximately $1,050, a price near $9,000 would be consistent on a logarithmic scale, an ambitious yet historically grounded projection. Investors are now turning their attention to upcoming U.S. economic data, including the Michigan Consumer Sentiment Index and new signals from the Federal Reserve. For gold, key resistance levels to monitor are $3,475 and $3,503, while silver is eyeing a potential breakout above $36.65. Until then, technical consolidation, along with macroeconomic and geopolitical developments, will likely dictate near-term price action across the precious metals market. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
There was a mistake by many investors back in early April when the stock market in the U.S. had that puke. You know, we had the little mini crash drop. Well, actually, it was only 20% from the high, but still a sharp drop. They dumped into the commodity complex then too, thinking, well, if the economy is going to be bad, so are commodities, and they treated silver not like it's part of the gold market, but it's part of the commodity sector. So gold pulled back like 3 or 4 or 5%, nothing hardly. And silver dropped from $35 to $27.50 in a matter of like a week or so, most of that occurring in 2.5 days in the end of the first week of April. 27.50, and I no doubt everybody in silver pulled their hair out. Well, all of a sudden now we got to 37, and it's only been what 2 months, basically 2 months. So that was a falsehood. So your question was move with gold. Silver, I think, suddenly realized, oops, I don't belong down here. I'm not a base commodity. I'm coming out of here, and it came out in a vortex manner. And by the way, so did commodities. They came up out of the hole as well. And I think that was a statement that anybody paying attention should realize. Silver is part of the monetary complex. It is a money. And don't be trapped by those occasional times when it seems to say, no, I'm not, because it ultimately will track with gold.
Yeah. How are we seeing this translate in the equity market?
Yeah, I sent you a couple charts. First one was the GDX spread versus gold. And what we did is we went back to 2015 on that chart, which is what? That's when both of those markets made their net price bear lows in December of 2015. And we plot month to month, where did GDX close in its relationship to gold? Meaning we divide GDX price into the price of gold, express it as a percent. And therefore, that's the chart. In fact, there's two charts there. One's a momentum chart below the top chart, which is the spread chart. But you'll see that since 2020, over the last 10 years at least, there's been a couple times when GDX got up to the upper range of that spread chart. But in 2020, it got up there again. And then since 2020 through just recently, the miners have, while they've risen in price, they've underperformed gold. They've not matched its gains on a percent basis. But that spread is breaking out now. And it's a pretty good, clear trend line you can see on that spread chart, where since 2000, so 4 full years of pulling back on the spread, if that were a price chart, the top chart, you'd say, I won't buy that. It's breaking out. And the momentum chart below is even doing more so. It's even stronger looking. So what we're arguing is now that not only will the metals likely accelerate in their price advance, percent gain month over month, but GDX will beat gold. The miners are coming back. There's another chart I sent you that goes back to the 1980s. And that chart shows the monthly closes of the XAU index, which has been around since then, which is the Philadelphia Gold and Silver Miners Index. And what we've plotted there is each month's close of XAU in relation to an ounce of gold. Okay. And you can see that from the 1980s through about 2007 or so, that spread remained in a range with lows at around 17.5%, again, dividing XAU into gold, and highs up around 30-something% over. So that was its ground then. That's where it lived, in that range, up and down, up and down. But then when the bear market started, actually before that, the spread started to break down through the bottom of that range that you can see, again around 17.5%. And sure enough, the bear market in both miners and gold followed in the couple years that followed. That spread collapsed into 2015 down to like 4-something%. Okay, this is something that had existed in a range from 17.5 to 35. And it dropped. Now, if this were a price chart, and you knew it's not going to zero, I mean, the gold miners aren't going to zero, okay? That spread chart effectively got to zero. And since then, actually the spread is up. We're right now at about 6+% XAU index divided into the price of gold. So it's a couple percent off of its low that occurred 10 years ago, the spread low, which actually means, if you do the math, it's done better over the last 10 years than has gold, even though that spread chart is still laying in that basing action. We think that spread's about to move up out of that base. Okay, let's assume that's true. Like the evidence I showed with GDX versus gold. Okay, XAU, same story. You come up out of that base and you look at that chart of XAU versus gold and treat it as a price chart, and you draw that line at the lows of 1980s, 1990s into 2000. It says, oh, where's resistance? Well, about 17.5%. You come up out of this base on XAU versus gold, and you could triple its relative value to gold. And in other words, if what we've been seeing for 10 years is basing action of the miners versus gold, and they're coming up out of here now, which we assess that they are, the next resistance is effectively a triple from current levels. Meaning, whatever we see over the next year or two in gold, you're likely to see the gold miners double and triple what gold is doing, just to get back to the bottom end of its old reality. Now, what does that mean? It says, well, watch gold, but you want to be in the miners.
MichaelOliver highlights that both macroeconomic and technical conditions are aligning for what could be an explosive move in gold. Record debt levels, aggressive fiscal and monetary policies, concerns about currency debasement, escalating geopolitical fragmentation, and a global shift toward hard assets, particularly by central banks, are forming a powerful backdrop. These structural shifts are reinforcing gold's long-term bullish case. Gold prices have extended their rally into a third straight session on Friday, reaching the highest level in 7 weeks. The metal continues to benefit from expectations of rate cuts, as well as rising geopolitical tensions in the Middle East. With Israel reportedly striking Iran's central uranium enrichment facility at Natanz and Iran signaling a strong retaliatory stance, the demand for safe haven assets is intensifying. Traders are now eyeing a potential retest of gold's all-time high near $3,500 should the conflict escalate further. However, the situation remains complex. While gold is buoyed by haven flows, the US dollar, also considered a haven, has seen intermittent strength. This dynamic could cap gold's upside in the short term if dollar demand accelerates. Oliver notes that although gold has been grinding higher in recent weeks, the price action may only be laying the foundation for a much steeper move. Historically, such quiet climbs have often preceded more dramatic surges. The market, he suggests, may be on the verge of a parabolic advance that could even surprise those already positioned bullishly. Let's get back to the interview.
Well, it's an ongoing trend. And first, in other words, MSA, based on annual momentum of gold, went bearish in 2012 and then went bullish in February of 2016. Nothing since February of 2016, that was like 3 months off the low. Gold then was like $1,140. Nothing on annual momentum since then has changed. It's had ups and downs, but the trend has remained positive. And therefore, long-term basis, we just simply remain bullish. We ignore the sell-offs. They don't last. And I think we've now entered, especially in silver, an acceleration phase where what we've seen, for example, last March of 2024, we put out another signal on gold and silver and the miners that said, okay, the sleepy period we've just gone through, 2020 to 2023, is over. We're going back up. We're going to accelerate. Not full acceleration, but we're going to come up out of the hole. And they did. They surged big. Gold was 2,000, it's now 3,400. Silver was 25, 26, it's now 37. Okay. There was a pause, though, for example, in the silver market. If you go back to last May, silver got up to $32.70 in a surge. And then it went more or less sideways, but in a widening type pattern of up, down, up, down. But you could draw a line from May of last year across the next year of action, and it simply cut right through it. Silver went above it, went below it, but basically it was nothing. Silver held its own. And during that time, our long-term momentum studies showed that it was in a corrective phase, meaning momentum, which got sort of overheated last May, started to correct. And when you look at a momentum chart, there's this perfect, beautiful channel that we were in since May of last year through 2 weeks ago. And when silver came back up recently to 34.90, near its prior two highs at 35, that structure broke out. And boy, within a week or so, we're 37 bucks. I think that's the beginning of an acceleration move in silver that will do two things. Put silver well beyond the old 50 highs, and probably within the next 3 to 5 months that will occur. Meaning something like $60 to $70 would not surprise at all. Not that that's the end of the move. That's just what's likely to unfold in the next 3 to 5 months. I think also during that time, you'll see silver start to outperform gold in a fairly dramatic way. Where silver now, as we know, is very undervalued to gold. And when we technically analyze that spread relationship between silver and its mama market gold, we see the upturn occurring, where silver's starting to break out versus gold. And I think that, plus the acceleration of the price of silver, those combined will create a situation in silver that will be stunning for most people, and will also surprise those who thought gold was going to lead, because I think it's going to be the other way around, though. Same is true with the miners, by the way. Yeah, gold has done really nothing so far, but it says, my, what a move. Really, the 1980 peak, when we got to 850 gold, was an 8-fold move. Okay, the 2000 to 2011 move was an 8-fold move. Okay, gold is coming from a bare low at 1,050. Eightfold is like $9,000. Okay, that would only be matching the logarithmic scale move that we've already seen twice in the past 50 years. And those times were far less dynamic, both fundamentally and technically, than now. We have more dynamite in the box right now than ever in terms of these other, we were talking about these other markets, which will help drive central banks into craziness. We'll see it on the spread, and I'm not going to try to explain why it's occurring. And, the whys would be what I just said: money moving into the gold and silver miners, and a lot of that money seeking the lower priced ones, so they can buy more of them. You get the psychological idea there. But the other factor is the silver relationship to gold. And by the way, on a net price basis, the current surge that we're in the miners in general, like GDX, GDXJ, or SIL, I think it's easy in the next 3 to 5 months that we will exceed the 2011 price peaks. I think that's no issue. And of course, if gold ever does its normal, which is to say an eightfold move, and XAU goes up to 17.5% or triples its current relative value, wow. I mean, it will be the hottest place in the market. And the issue is, you should have gotten in already. And if you're going to get in, you better get in now, because in 5 months from now, it's going to be a much higher risk, much more volatility, and you're getting in late.
As precious metals rally on the back of shifting monetary expectations and heightened geopolitical uncertainty, the market tone is moving decisively to optimism. Silver's sustained elevation above key price thresholds and gold's steady progression through resistance levels are signaling a potentially transformative phase. Investors are closely watching how external shocks and central bank actions will reshape the risk landscape. Meanwhile, rising interest in miners and historical performance patterns is adding layers of conviction to long-term bullish projections. Could the market's steady advance in gold and silver be a prelude to an explosive revaluation? Or are investors underestimating the risk of a reversal in sentiment? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.